Hello friends, welcome to Shavia School. I am Dr. Chetan and today I discuss with you Economic Survey of India 222. There has been a revival in economic activity to pre-pandemic level in the year 21-22, even though the health cost of the second COVID-19 wave was much more severe. The economic cost of it was much wider on the total consumptions. India is just shy of where it was before the pandemic, and while government consumptions has been reasonably strong, but private consumption still lags. Finance Minister Nirmala Sitharaman tabled the Economic Survey 21-22 in the Parliament for the second year running. The Economic Survey was written under the cloud of the COVID-19 pandemic. The Economic Survey was tabled in Parliament by the Finance Minister soon after the President address to the both House of Parliament. The Economic Survey is a report card of the economy. It is tabled in Parliament by the Finance Ministers one day before the Union Budget presentation. The central theme of the year of Economic Survey is the agile approach. This year, survey used various examples to highlight the use of satellite and geospatial data to reflect the infrastructure growth in the country. What is Economic Survey? The Economic Survey of India is an annual document released by the Ministry of Finance. It contains the most authoritative and updated source of data on India's economy. It is a report that the government present on the state of the economy in the past 1 year, the key challenges it anticipates and their possible solution. It is prepared by the Economic Division of the Department of Economic Affairs under the guidance of the Chief Economic Advisor. It is usually presented a day before the Union Budget is presented in the Parliament. The first economic survey in India was presented in the year 1950-51 up to 1964. It was presented along with the Union Budget. From 1964 onward, it has been delinked from the budget. State of the economy. Last 2 years have witnessed a repeated wave of COVID-19 pandemic world over, leading to supply chain disruptions and recently inflections challenging the overall policy paradigm. Government of India also have enhanced capital expenditures on infrastructure to boost medium-term demand and also implemented supply-side reform for long-term economic affairs. The Indian economy is estimated to grow by 9.2% in the real time in 21-22. Subsequent to a contraction of 7.3% in the 2021, the gross domestic product projected to grow to by 8 to 8.5% in real terms in 22-23. Projection comparable with World Bank and Asian Development Bank latest forecast of a real GDP growth of 8.7% and 7.5% respectively for 22-23. According to the International Monetary Fund latest World Economic Outlook projections, India's real GDP is projected to grow at 9% in 2021 to 22 and 22-23 and at 7.1% in 23-24, which would make India the fastest growing major economy in the world for all 3 years. Combination of high foreign exchange reserve, sustained foreign direct investment, and rising export earning will provide an adequate buffer against possible global liquidity tampering in 22-23. Tapering is a theoretical reversal of quantitative easing policies, which are implemented by the central bank and intended to estimate economic growth. Indian policymakers saw the disruptions caused by travel restrictions, lockdown, and supply chain breakdowns as an interruptions of the economy supply side. Although this also skews demand, it is not correct to see the pandemic-related economic slowdown as a just a demand problem as happens with the most economic cycle. New guidelines for a procurement and project management were enhanced in October 2021. Structural and process reform for telecom sector. Example, AGR issues and drone rules announced in August 2021. Fiscal developments. Overall, over the last couple of years, a calibrated fiscal policy approach to the pandemic has been adopted by the government. This approach has the flexibility of the adapting to an evolving situations in order to support the vulnerable sections of society. A calibrated fiscal policy approach enable a resilient recovery. Sustain, sustain revenue collections and a target expenditures policy has contained the fiscal deficit for April to November 2021 at 46.2% of budget estimate. The revenue received from the central government April to November 2021 have gone up by 67.2% year on year, as against an expected growth of 9.6% in the 2022. Gross tax revenue registered a growth of cover 50% during the April to November 2021. This performance is strong compared to pre-pandemic level of 2019-20 also. Tax revenue from part of the received budget, which in terms is a part of the annual fiscal statement of the union budget. During April-November 2021, capital expenditure has grown 13.5% with focus on infrastructure's intensive sector. With the enhanced borrowing on account of COVID-19, the central government debt has gone up from 49.1% of GDP in 2019-20 to 59.3% of GDP in 2021, but is expected to follow as a decline trajectory with the recovery of the economy. Buoyant tax revenue and government policies have created a headroom for taking up the additional fiscal policy intervention. Stressing the need to continue the focus on capital expenditure, it has indicated that the government is on course to achieve the fiscal deficit target of 6.8% of GDP of the current year 2021-22. External sector. External trade recovered strongly in 2021-22 after the pandemic induced slump of the previous year, with strong capital flow into India, leading to rapid accumulations of foreign exchange reserve. However, the downside risks may pose a challenge for India during 22-23. Global liquidity tightening, continued volatility of global commodity prices, high freight cost, the fresh resurgence of COVID-19 with a new variant, India merchandise export and import rebounded strongly and surpassed pre-COVID levels during the current financial year. There was a significant pickup in net service with both receipt and payment crossed the pre-pandemic level despite weak tourism revenue. Net capital flow were higher and at USD 65.6 billion in the first half of 2022, 21-22 on account of a continued inflow of foreign investment revival in a next external commercial borrowing, higher banking capital and additional special drawing rights allocations. As of end November 2021, India was the fourth largest forex reserve holder in the world after China, Japan, and Switzerland. Monetary management and intermediations. Since May 2020, the policy rates have been on hold along with the accommodative monetary policy stance by keeping the repo rate at 4% to balance growth recovery and inflation target. The reason for keeping the repo rate to check inflationary pressure against the view of view economics and banker throughout this year are twofold. Adverse supply shocks, fluctuating aggregate demand throughout this year. The liquidity in the system remained in surplus. Repo rate was maintained at 4% in 2021-22. Reserve RBI undertook various measures such as a GSEC acquisitions program and special long-term repo operations to provide further liquidity. The economic shock of the pandemic has been weathered well by the commercial banking system. Bank credit growth accelerated gradually in 21-22 from 5.3% in April 2021 to 9.2% as on 31st December 2021. The gross non-performing advance ratio of scheduled commercial bank declined from 11.2% at the end of 2017-18 to 6.9% at the end of September 2021. Net non-performing advances ratio declined from 6% to 2.2% during the same period. Capital to risk weightage as a ratio of SEBs continued to increase from 13% in 2013 to 14 to 16.5% at the end of September 2021. The return on asset and the return on equity for public sector bank continue to be positive for the period ending September 2021. The growth in the reserve money has been mostly by drawing by banker deposit with the RBI from the component side with the CRR restorations in spaces. Exponential year for the capital market. Rupees 89,666 crore was raised via 75 initially banking public offering that has been IPO issue in April to November 2021, which is much higher than in any year in the last decade. Prices and inflation. And economic activity started showing sign of picking up in the second year of the pandemic. The global economic face the fresh challenges of rising global inflections. COVID-19 related to stimulus spending in the major economies along with pent-up demand boosting consumer spending push up inflections up to many advanced and emerging economies. The average headline consumer price index combined inflections moderate to 5.2% in 2021-22 from 6.6% in the corresponding period of 2021. The decline in the retail inflections was led by easing food inflections. Food inflections average at a low of 2.9% in 2021-22 as against 9.1% in the corresponding period last year. Effective supply side management kept price of most essential commodity under the control during this year. Proactive measures were taken to contain the price rise in pulses and edible oils. Reduction in central excise and subsequent cuts in value-added tax by most states help ease petrol and diesel prices. Wholesale inflections based on wholesale price index rose to 12.5% during 21-22. This has been attributed to low base in the previous year, pickup in economic activity, sharp increase in the international price of crude oil and other imported inputs, and high freight cost. Divergence between CPIC and WPI inflections. The divergences pick up to 9.6 percent points in May 2020. However, in 2021, there was a reversal in divergence with the retail inflections falling below wholesale inflections by 8% points in December 2021. This divergence can be explained by factors such as variations due to base effect, price collections, atom covered, difference in commodity weight, and WPI being a more insensitive to cost push inflections led by imported input. With the gradual waning of base effect in WPI, the divergence of in CPIC and WPI is also expected to narrow down. Su- Sustainable Development and Climate Change. In September 2015, 193 countries, included India, committee to with Sustainable Development Goals as a detail in the UN resolutions transforming our world. The 2020-30 Agenda for Sustainable Development. The SDG comprehensively cover social, economic, and environmental dimensions and build up on the Millennium Development Goals, which cover the earlier 15 years period for 2000 to 2015. India has been making stride toward achieving the social, economic, and environment goal cover under SDGs. India overall score on the Niti Aayog Sustainable Development Goals India Index and dashboard improved to 66 in 2021-22 from 60 in 2019-20 and 57 in 2018-19. India has the 10th largest forest area in the world. In 2020, India ranked third globally in increasing its forecast forest area during 2010 to 2020. In 2020, the forecast covered 24% of India's total geographical area, accounting for 2% of the world's total forecast forest area. In August 2021, the Plastic Waste Management Amendment Rules 221 was notified, which is aimed at phasing out single-use plastic by 2022. Draft regulation on extended producer responsibility for plastic packaging was notified. The compliance status of polluting industries located in the Ganga mainstream and its tributary improved from 39% in 2017 to 81% in 2020. The Prime Minister has a part of the national statement delivered the 26th Conference of Parties in Glasgow in November 2021 announced ambitious target to be achieved by 2030 to enable further reductions in emission. The need to start the one word movement lifestyle for environment, urging mindful and deliberated utilization instead of mindless and destructive consumptions was underlying. Agriculture and food management. The agriculture sector has experienced buoyant growth in the past 2 years. The sector, which is the largest employer of workforce, accounted for a sizable 18.8% to 21-22 in gross value added of the country, registers in growth of 3.6% in 2021 and 3.9% in 2021-22. Growth in allied sector Growth in allied sector, including livestock, dairy, and fisheries, has been the major drivers of overall growth in the sector. This positivity growth become possible due to good monsoon, various government measures to enhance credit availability, improve investment, created market facility, promotion of infrastructure development in the agriculture sector. The agriculture sector experienced buoyant growth in the past 2 years, account accounting for a sizable 18.8% in, in a gross value added of the country, registering a growth of 3.6% in the 2021 and the 3.9% 2021-22. Minimum support price policy is being used to promote crop diversifications. Net receipt gross Net receipts from crop productions have increased by 22.6% in the latest situation assessment survey compared to the SAS report of 2014. Allied sectors, including animal husbandry, drying, and fisheries, are steadily emerging to be a high growth sector and major drivers of overall growth in the agriculture sector. The livestock sectors has grown at a CAGR of 8.15% over the last 5 years ending 2019-20. Government facilitated food processing through various measures of infrastructure development, subsidies, transportations, and support for formations and promotion of micro food enterprises. India, run, a- India runs one of the largest food management programs in the world. Government has further extended the coverage of the food security network through scheme like PM Garib Kalyan Yojana. Industry and infrastructure. Global industrial activity continue to be affected by the disruptions caused by the COVID-19 pandemic. While the Indian industries was no exceptions to those disruptions its performance has improved in 2021-22. The index of industrial productions grew at 17.4% during 2021 as compared to 15.3% in April-November 2020. Capital expenditures for the Indian Railway has increased rupees 1 lakh 55,181 crore in 2021 from the average annual of rupees 45,980 crore during 2009 to 14, and it has been budgeted to further increase rupees 2,15,058 crore rupees 2021-22, a 5 times increase in comparison to the 2014 level. Extent of road constructions per day increased substantially in 2021-22, 36.5 kilometers per day from 28 kilometers per day in 2019 to 20, a rise of 30.4%. Net profit to sale ratio of large corporations reached an all-time high of 10.6% in July-September quarter of 2021-22 despite the pandemic. Introductions of Productions Link Incentive Scheme. Major boost provided to infrastructures both physical as well as digital, along with the measures to reduce transactions cost and improve ease of doing business. World support the peace of recovery. Services. While the services sector contribute over the 50% of India's GDP, the COVID-19 pandemic has had a adverse impact on the service sector as its share in India's GVA declined from 55% in 2019-20 to 53% in 2021-22. Gross value added of service of the cross pre-pandemic level in July-September quarter of 2022. However, GVA contact intensive sectors like trade, transport, etc. still remain below pre-pandemic level. Overall, service sector GVA is expected to grow by 8.2% in 2021-22. Foreign direct investment. During the first half of 21-22, the service sector received over USD 16.7% billion foreign direct investment, accounting for almost 54% of total FDI inflow into India. Reforms. Sorry for misconvenience. Reforms. Major government reforms include removing telecom regulations in IT BPO sector and opening up of the space sector to private player. Export services export surpassed pre-pandemic level in January-March quarter of 2021 and grew up by 21.6% in the first half of 2022, strengthening by the global demand for software and IT service export. Startups India. India has become the third largest startup ecosystem in the world after the US and China. Number of new recognized startups increased to over 14,000 in 21-22 from 733 in 2016 to 17. 44 Indian startups have achieved unicorn startups in 2021, taking the overall tally of unicorns to 283, most of which are in the service sector. Social infrastructures and employment. The need for a strong and resilient social infrastructures have become even more important during the ongoing COVID-19 pandemic that brought into focus the vulnerabilities in social infrastructures across countries. Specifically, the pandemic exposes the challenges of balancing livelihoods while saving lives. Employment. With a revival of the economy, employment indicator bounce back to pre-pandemic level during the last quarter of 2020-21. As per the quarterly periodic labor force survey data up to March 2021, employment in urban sectors affected by pandemic has recovered almost to the pre-pandemic level. According to Employees Provident Fund organizations data, formalizations of job continue during the second COVID wave. Adverse impact of COVID on formalization of jobs much lower than during the first COVID wave. Social infrastructures expenditure on social service by central and state has a proportions of GDP increased from 6.2% in 2014-15 to 8.6% in 2021-22. As per the National Family Health Survey, total fertility rate came down to 2 in 2019-21 from 2.2 in 2015-16. Infant mortality rate, under 5 mortality rate and institutional birth has have improved in 2019-21 over year 2015-16. Under Jal Jeevan missions, 83 districts have become Har Ghar Jal districts. Increase allotment of fund to Mahatma Gandhi National Rural Employment Guarantee Scheme to provide a buffer for unorganized labor in rural areas during the pandemic. In addition to the National Health Mission, Union Budget 221-22 announced Ayushman Bharat Health Infrastructure Mission and a new centrally sponsored scheme to develop capacities of primary, secondary, and tertiary health care system, strengthen existing national institution, and create new institution to cater to detections and cure of new and emerging diseases. India is among the new countries producing COVID vaccines. The country started with two made in India COVID vaccines. In line with India's vision of Atmanirbhar Bharat, India's first domestic COVID-19 vaccines, whole viral inactivate coronavirus vaccines, that is means Covaxin, was developed and manufactured by Bharat Biotech International Limited in collaborations with National Institution of Virology and Indian Council of Medical Research. The progress of vaccinations should be seen not just as a health response indicator but also as a buffer against economic disruptions caused by repeated pandemic wave. Please subscribe this channel. Thank you very much.